When most people think about retirement planning, they think about investments. But one of the biggest financial risks in retirement is actually healthcare. And it's not just the cost itself. It's understanding how you bridge the gap to Medicare, how long-term care fits into the plan, and how retirement income can quietly increase your Medicare premiums. Those are some of the most overlooked parts of retirement planning. Hi, I'm Matthew Fitzgerald, certified financial planner with Holistic Planning, located in beautiful Sedona, Arizona. And today, I want to walk you through how we think about healthcare planning in retirement, because this is one area where small decisions today can have a major impact later on. Let's get into it. One of the first issues many early retirees face is the gap between retirement and Medicare eligibility, because Medicare generally doesn't begin until age 65. So if someone retires at 60, 62, or even 55, there may be several years where they still need private health coverage, and that can become expensive if it's not planned for. Typically, we help clients evaluate a few different options. That may include COBRA coverage from a previous employer, healthcare.gov marketplace plans, or healthcare sharing programs like MediShare, depending on the situation. There's no one-size-fits-all answer here. The right option depends a lot on income, health history, retirement timing and spending, and overall financial structure. But the key is making sure this transition is already planned rather than reacting to it after a retirement has already begun. Another major conversation topic is planning for long-term care expenses later on in life. This is one of those topics that's commonly avoided because it makes folks uncomfortable to even think about. But statistically, many retirees will need some form of extended care later in life. The real question is, how do you plan for that possibility? For some people, the answer may be long-term care insurance. For others, especially high net worth families, it may make more sense to self-insure and reserve assets and define a goal specifically for healthcare costs. There's not a universal answer here. What matters is understanding the trade-offs and making the decision proactively instead of emotionally during a crisis. Estimating future healthcare costs. This is where financial planning tools become really valuable, because we can actually model estimated future healthcare costs, like long-term care, into the retirement plan. That includes things like insurance premiums, out-of-pocket expenses, potential long-term care needs, and inflation over time. A lot of people underestimate how much the future costs of care can compound over a 20 or 30-year period. So rather than guessing, we want to quantify those risks and put them intentionally into a financial plan. The Medicare penalty box. Another issue many retirees don't understand exists is something called IRMAA. This stands for Income-Related Monthly Adjustment Amount. But most clients remember it better when we call it the Medicare penalty box. Here's what happens. Your Medicare Part B and Part D premiums are tied to your income. So if your retirement income crosses certain thresholds, your Medicare costs increase, sometimes significantly. These premiums are not adjusted until 2 years after the high income year. And what surprises people is this can happen because of large IRA withdrawals, Roth conversion timing, capital gains associated with the sale of a business or investments, or even one unusually high income year. So now you have a situation where someone unknowingly trigger thousands of dollars in additional Medicare premiums just because income planning wasn't coordinated properly. And this is why tax planning and healthcare planning often go hand in hand with one another. A common example we see is someone retiring at age 62 with a few $1,000,000 in their pre-tax retirement account. At first, they're mainly focused on creating retirement income and getting healthcare coverage until Medicare begins. That higher income can actually trigger higher tax brackets, higher Medicare premiums, and additional stress around cash flow, especially because those adjustments don't take place until 2 years after a high income year. Instead, we may structure a strategy where we gradually smooth income over time through Roth conversion timing, withdrawal sequencing, tax-efficient income sources, and proactive healthcare planning. Now, instead of reacting year to year, the retirement plan becomes much more coordinated. Key takeaway: healthcare planning in retirement is much more than just having insurance. It's about understanding how healthcare costs, taxes, income planning, and longevity all interact over time. And the earlier you plan for these decisions, the more flexibility you typically have. If you're approaching retirement and trying to understand what healthcare could realistically cost, or how Medicare and taxes can affect your long-term plan, that's usually the right time to have a conversation. You can schedule a complimentary consultation using the link below below with me, and we'll walk through your current situation and help you identify potential risks and opportunities before retirement begins. At the end of the day, retirement planning is about preparing for the realities of life, not just the ideal scenarios. And healthcare is one of the biggest pieces to that puzzle, so you can worry less and live more. Thank you.